and welcome into Making Sense. You know, if you like going to an amusement park, and especially like the roller coasters, I'm sure you're going to really have enjoyed what's been happening in the stock market for about the past 2 or 3 weeks. One week it's up, or one day, the next day it's down and up and down. You're probably saying, what's going on and why is this happening? So we went to the source, Brandt McDonald, with McDonald, Barranco, and Hagen Wealth Management. Good to have you back, buddy.
Yeah, absolutely. It's great to be back. I know.
And you know, we're getting now into April, and things are a little bit kind of up and down, aren't they?
Yeah, you know, Jack, I tell you, at the end of last year, the first part of this year, you know, I got out there, sort of put myself on the line a little bit, because one of the things that we really felt strongly about was that we might be, you know, have some production this year in terms of productivity in the S&P 500, make some progress from year over year, but boy, it was going to be a tough slog, and that's sort of what we felt very strongly about. And so far, we've gotten that. I mean, extreme volatility. And we tried to forecast to most of our clients and to the public through the various media outlets that I use, which is either on the radio or in my boom column, to warn everyone, you know, strap in, buckle up, because there are a lot of headwinds we're facing. You know, and I think the big issue is when you look at central bank activity, what the Federal Reserve did for the last 4 or 5 years with QE and the expansion of their balance sheet. They created this huge asset bubble, I think, particularly in U.S. equities, the S&P 500, the Dow Jones Industrial Average. Well, they ended that in October of last year, and now we're trying to sort of normalize in this last 6 months within, you know, life without QE. And now this discussion has come about that, you know, hey, we're going to probably see interest rates begin to normalize, or the Fed might move from their zero interest rate policy back to rate normalization. I've been in the camp that I think that's going to be difficult for them to do.
Keep kicking the can down the road.
Well, they're boxed in.
Yeah,
I mean, they're trapped right now. You know, and of course their mandate is to seek full employment and also, you know, to monitor inflation. We don't want to get too far down into the weeds on those subjects, but I can tell you that they still see some bit of a problem in both of those. Even though the trajectory has been improving in those areas, I think we still are not out of the woods there. And so who knows, but I think the market is really grappling with this. In the meantime, we've seen the U.S. dollar absolutely skyrocket relative to all other developed countries. If you look at the dollar valuation relative to the yen or to the euro, it's, as I say, been steadily screaming higher. And I think the rest of the globe, the rest of the international community has been seeking dollar-based assets as a haven for risk that's based in their local markets. This has been very problematic, particularly for U.S. large multinational companies, because they're looking into their end markets. They're seeing a little bit of weakness there because those are bad markets to begin with. But then when you start to contemplate the idea of converting those currencies, local currencies, back into dollars without a really great hedging strategy, it's going to hurt them. And so here we are, you know, in April, and we're right here on the cusp of first quarter earnings coming out. And I will tell you, for me and for our team, we want to really be dialed in to hear what corporate CEOs here in America are saying about their end markets, particularly internationally. And we're not so much going to be concerned about earnings or earnings per share as much as we're concerned about revenues. Revenues equal demand, and if that demand is not stable to steadily climbing, then we're going to have a problem, because valuations are already a bit stretched in the market. And so my anticipation is that we're going to continue to expect extreme volatility for the rest of this year. And if it were me, I would say that in the last few months, for most of our accounts, we've been very, I would say, defensively postured, maybe even a little too early, but that's okay. And I think that it's well worth doing that, particularly considering, as I say, the risk reward and all the headwinds that we're facing. And so, just to recap, when you look at central bank activities, that's been a real headwind. And by the way, we haven't even gotten into Vladimir Putin wanting to run amok through the Baltics, particularly Ukraine, the Chinese credit markets that are broken in that shadow banking system, the Middle Eastern turmoil, which appears to be a little bit of a hot war that may be really getting fired up over there. And then obviously the European situation, where you've got a recession best case in a depression in some markets, particularly the southern European nations. So there's a lot of stuff out there that really needs to be paid very close attention to.
Well, and it's not just about us anymore. Like you say, it's the world.
Right.
Yeah, you have to take the whole world into consideration.
Right.
Well, what I would suggest for our viewers is the fact that if you're in the stock market at all and you're doing it on your own, it's probably going to be very risky.
Yeah,
unless you really know what you're doing. This is not something that people sometimes use the word play with it. This is not play, it's your money, it's a real thing.
Well, one of the things I've always said, Jack, is know what you own and why you own it. And that's been the number one problem I see with our new clients especially. They come in and they've either been sold a product they know nothing about, or they own investments that in the past have done well, and so they think they're going to continue to do well. That's not a good way to manage your investment portfolio. You really have to understand the impact, significant impact of global economic activities, central bank activities, and what it can do to your investment portfolio. And so whether it's us or someone else, you've got to get with a true professional who really understands this and that can help you guide you through sort of this, maze of financial markets.
Okay, well, thank you so much. And just remember this, it's your money, watch it carefully, but more importantly, get help, because that's the best way to ensure that you're going to have the money that you need when you need it. We'll be right back right after this.